What percentage of your investing portfolio should be allocated to the UK? If you're based in the UK, should you have the majority of your portfolio invested in UK stocks and funds? The media, familiarity and patriotism can negatively affect the way we invest and, more importantly, our investing returns.
In this video, we're going to look at investing with home bias and the reasons for and against it, and we'll discuss what our views are and how they might have changed. By the end of the video, we hope to have given you a clearer idea about how to invest with the goal of minimising risk and maximising profits. Let's check it out.
Welcome to moneyunshackled.com, the investing and finance channel and website that says you and your finance is free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
First, we want to give a special shout out to commission-free trading platform Stake, who are sponsoring this video. Stake specialises in US stocks for UK investors and offers 3,000 of them. Stake is FCA regulated, has fractional trading, and there are no FX fees when you trade.
Investing in the US is one way to reduce your home bias. And they are giving away a free US stock worth up to $100 to everyone who signs up via our link.
We'll put the link to the offers page in the description below, so be sure to check that out. Now let's get into the video. What is investing home bias? Investopedia defines home bias as the tendency for investors to invest the majority of their portfolio within domestic equities. This means a UK investor would have the majority of their portfolio in UK stocks, and a German investor would have the majority of their portfolio in German stocks, and so on.
But home bias is also where a person invests more heavily in domestic equities than the relative size of its stock market in global terms. For example, with the UK stock market currently making up about 4% of global market capitalisation, any portfolio allocation over 4% in UK stocks would be demonstrating some home bias.
According to findawealthmanager.com, it is estimated that the average UK investor holds more than half of their investments in domestic securities. Yet Great Britain accounts for only about 3% of global GDP and has less than 1% of the planet's total population.
Further to this, a study by Morningstar found that 24% of UK investors only invest in UK stocks for their allocation to equities. Think you're globally diversified? Think again. In an episode not that long ago, linked below, we deep dived into one of my old workplace pensions and discovered UK home bias in its droves. Your pensions are likely to be similarly weighted. Check this video out next to find out what you can do about it.
How we used to invest. When I first started investing over a decade ago, I was heavily weighted in favour of UK stocks. This was because all the sources of my education at the time pushed that agenda. I soon learned the error of my ways, and since the creation of this YouTube channel, we've been critical of investing strategies where the investments are heavily weighted toward the UK.
This has nothing to do with patriotism. We love the UK, but we don't see the benefit financially of heavily tilting your portfolio towards the UK market. Not only are you increasing your risk, but you're likely lowering your returns.
There is a long history of US stocks outperforming those of the UK and the rest of the world, and emerging markets are showing glimpses of growth potential far exceeding that of our developed home market.
As we can see here, the UK has massively underperformed the world over the last 15 years. US stocks have been the driving force of this huge growth. A £100 investment in the UK would have returned just 30%, but a £100 investment in the world would have been 182%.
However, for right or wrong, we still decided to stick with a small element of home bias, choosing to hold around 15 to 20% in UK equity. Recently, we've been thinking that it was the fear factor of going against consensus that prevented us from dropping that home bias entirely.
Wrong lessons. There's a substantial UK bias in the media towards investing, which no doubt impacts on our beliefs and actions, a form of groupthink. For example, on the rare occasions that investing news is reported on TV, radio and elsewhere, it is almost always about the FTSE 100. This slowly poisons the mind to the point that you think that the FTSE 100 is the centre of the investing universe, when in reality it's just a drop in the ocean.
Things might be beginning to change now though, with the US stock market getting ever more prominent and a growing awareness of its importance over our domestic stocks. Nevertheless, you will barely ever hear about other international stock markets. We would argue that the most important indexes that should be reported on are world indices such as MSCI All Country World Index. Yet we've never heard this on the news.
Reasons for home bias. Number 1. Accessibility and cost. The advancement of technology has massively improved accessibility to global stock markets, but it's still easier to invest in UK stocks even to this day. Most UK investment platforms will offer the full range of listed UK stocks, and the fees to trade these are still often cheaper than for other international markets.
For instance, many platforms will charge you FX fees on every international trade, so acts as another barrier to international diversification. We would argue that as long as you build a portfolio consisting of index funds and ETFs listed in pounds, then this is no longer a real barrier to global diversification. But for individual stock picking, we can see the benefit of some home bias.
Number 2. Currency risk. Your living costs are tied to the UK economy. Most UK companies are listed in sterling and report in sterling, so your investments are more closely tied to your living costs. When investing internationally, even though your investment may have increased in share price, by the time you convert back to sterling, you may end up in a losing position due to currency fluctuations. Although this is a widely argued advantage of home bias, we don't see the benefit and will disprove it shortly.
Number 3. Tax advantages. If you watch our videos frequently, you'll know that we despise unfair taxes and do everything we can to minimise them, but sometimes paying higher taxes is still worth it. After all, it's the after-tax profit that matters most.
So, with this in mind, the UK is one of the most tax-efficient ways to invest. Most of the major economies will deduct dividend withholding tax from the dividend that is rightfully yours. So investing in UK stocks could be a way to enhance returns, with all else being equal. Some countries will offer ways to slightly reduce the headline withholding tax, but doing so can be extremely complicated and an administrative burden. You can see why UK investors might want to stick with UK stocks.
Number 4. Local knowledge. When investing in funds, this isn't really an advantage, but it certainly is when picking individual stocks. Picking stocks properly requires knowledge of the market they operate in. You probably don't have a clue about the retail market in Switzerland, but you do know what it's like in the UK, so local knowledge will massively help you to pick winning stocks. This is why Ben and I only ever pick individual stocks from the UK and the US, because we know them reasonably well.
Reasons against home bias. Number 1. Already overexposed to the UK. You have financial capital, which is the money, stocks and property that you own, and you have human capital, which is your ability to work and make money. There is a strong argument that as your human capital is completely tied to the UK economy, then you should limit your financial capital to other markets.
Some people even argue that you should underweight your financial capital to the UK below what the 4% world market cap suggests, because your human capital is so highly exposed. These arguments do make some excellent points. If a recession occurred in the UK because of local matters, then your UK financial assets would plummet at the same time as you lose your job and as your house value crashes.
You already have your entire life intertwined with the UK. If the UK economy did poorly for a sustained period, then your state pension would also be at risk, as well as the possibility of tax rate increases. It makes sense to diversify out of this risk where possible.
Number 2, other ways to manage currency risk. We don't buy the currency risk argument for sticking with home bias, because over the long term, currency fluctuations tend to level out. Plus, you can use currency hedging to eliminate this risk if you wish.
If you are concerned about currency risk, is it not better to still get exposure to international stocks for the benefits they provide, but also to hedge the currency risk? There are lots of currency hedged ETFs that can handle this for you. However, because we invest for the long term on a monthly basis, we're happy to ride out any fluctuations.
Also, if you're investing in the UK, you'll likely be investing in the huge global companies found in the FTSE 100. 75% of the FTSE's earnings come from outside the UK, so your investments are explicitly tied to global currency fluctuations anyway.
Number 3. Better diversification across sectors. The UK stock market is not represented by all key sectors and is maybe overexposed to some of them. Prior to COVID, there was a high reliance on oil stocks and financials.
Here is the Vanguard FTSE 100 ETF and its sector weighting now. There is clearly an absence of technology and perhaps too heavy a weighting towards consumer goods. Diversification across sectors is important to manage risk, which is why the FTSE was so heavily punished by COVID, which caused oil stocks and financials to tank.
Number 4. Avoids emotion. We think one of the best ways to invest is to pick a well-diversified strategy and stick to it. The news will always be overly negative because that is what sells. The problem is if you allow this negativity to influence your long-term investing strategy.
So if your portfolio is not tied to the UK, then you have fewer reasons to overreact. You won't hear what is happening in the industrial sector in Japan, for example, because our media won't report on it. This may sound counterintuitive, but it can give you an edge when investing.
What we're doing now. We have both decided to remove any home bias from our ETF portfolios entirely. However, when it comes to individual stocks, we will still only invest in UK and US stocks, because these allow us to take advantage of local knowledge, accessibility and availability of information. We'll be releasing a video over the coming weeks detailing our new portfolios. So if you're new to the channel and you don't want to miss this, hit subscribe.
Question of the day. What percentage of your overall portfolio do you allocate to the UK and why? Let us know down in the comments. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.